Possibly the most useful and looked over tool when making a technical analysis is the candlestick. But what are candlesticks and how can you read them? A candlestick is a visual representation of the price action. They can vary depending on the time frame chosen. These time frames can vary from minute to hours to days, even years. Why is it important? They can be very useful when it comes to deciding both entry and exit points for an investment or trade. If used correctly, the candlesticks could help provide an accurate decision for you. There's a good chance if you've seen a picture of a chart for a security, you've seen this. Each candlestick is displayed as either a red or a green rectangle. Green shows a positive movement and the red represents a negative price movement. These rectangles can have lines extending out of the top, bottom, or sometimes both the top and bottom. These lines are known as wicks, which we'll get into in a moment. To determine a color of the candlestick, the program sees where the previous one during the time frame left off. For example, let's say Spaceman was looking at security Out. If Out opens at $10 and in the first 5 minutes the stock is in high demand, then in theory the price should go up. Let's say that after the 5 minutes the price for one share increased to $10.50. In this case, if Spaceman were looking at the candlestick chart during 5-minute intervals, then the first candle would be green. The original price point of $10 will be at the bottom of the candlestick, and the new price point will be at $10.50 at the top of the candlestick. Now, in some cases, during the 5 minutes, it is possible for the price to extend further than $10.50 to a price like $10.60, but then go down and fluctuate to where the price closes at $10.50. If this is the case in our example, then the candlestick will show the line coming out of the middle of the green candle. Essentially, what the wick is showing us is that at one point during that time interval, the price extended either higher or lower than what the price started or ended at which relatively low volume. Now, let's say that during the next 5 minutes, people begin to sell because they made some profit. If there's more selling than buying, then the price will be driven down as the people wanting to buy begin lowering their bids for the stock. This will cause the next 5 minutes candlestick to be red. The top of the candlestick will be at $10.60 and extended down to a lower price. Let's say $10.20. From here at the $10.20 mark, there would be a whole new set of buyers. If that is the case, the next candlestick will be green. Starting at the $10.20 mark, but extending upward to a higher price during the 5-minute interval. What makes the candlestick so useful is that through a resource such as Yahoo Finance or Thinkorswim, you can change the time frame that you would like to see of the price action. As said before, time intervals can range from minutes to hours to days. For instance, if Spaceman were wanting to get into a stock for a day trade, it would be in his best interest to take a look at the intervals that display data from 5 minutes to 1 minute. This is because the candlesticks would show him a more precise version of tug of war happening at the time. But if you were wanting to hold it for longer than a day, it would be wise for him to use a time interval such as 30 minutes or the hourly. We realize how confusing and stressful it can be to take your first steps, so we've made it our mission to simplify the process. This is why we are building a community where you can interact with other individuals who are working to better themselves. Check out the investing and trading section of our forums on our website and create a profile. Whether you want to learn, discuss, or just socialize, join the Outlie community and become an outlier. If you have any questions, comments, or suggestions, don't hesitate to hit us up on any of our social media links below.